Hi everyone, welcome back to Financial Freedom Friday, where we discuss tips and strategies to help you achieve financial freedom. My name is Nate Scott. Great to be here with you again. Today we're talking about a hot topic in the world and has been for quite some time, and that's the difference between tax-deferred accounts and tax-free accounts, and which ones you ought to devote the majority of your money to. And so that's what we're going to talk about, the differences, and also three main questions that you should ask yourself when you're really determining which one you want to go into. So just to relate to you what we're doing, tax deferred accounts, those are things like your traditional IRAs and your 401ks. Those are things, what they mean when they say tax deferred, every dollar you put into it, you actually get to deduct on this year's tax return. So if I contribute $10,000 to my 401k, I have $10,000 less of income that year that I have to pay taxes on. And so if I make $100,000, I deposit $10,000 into that account, then I really am only taxed on $90,000. A lot of people think that's great, and it's kind of a short-term mindset, though. It's like kicking the can down the road, because we do know that if any time we, in the future, when we want to pull money from those accounts, when we retire or any time sooner than that, all the distributions, 100% of the money that comes out of that is going to be taxed at the normal income tax level. So it's not like it's a real expense, it's just it's a deferment. It just defers your taxes into the future. The other option is what's called the tax-free accounts, you could say, which are conventionally your Roth IRA and whole life insurance are the main type of tax-free accounts, where you put in after-tax dollars into the account. Meaning, if we had $100,000 of income and we put $10,000 in, we still pay taxes on the full $100,000. So we don't get to deduct the money we contribute to those, the Roth IRA and the policy. But when it comes to income time, we get to take all the distributions and not pay taxes on those. So one, we pay taxes, the after tax, we pay taxes as we build it. The other one, we pay less taxes as we're building, but we have to pay all the taxes when we start distributing it. And so when deciding which one you want to do, it's good to ask three main questions, and that will kind of help you see in reality which one you really ought to focus on. So the first question you ought to ask yourself is, do you think taxes are going to go up or down in the future? Now, if you're like most of us, we look at the national debt, we look at the spending issues in Congress, no matter who's elected in, and we say, wow, I really don't think taxes are going to go down. They're probably going to go up. But the main benefit for the tax-deferred accounts, what people are saying why we should do those, is that, hey, you'll be in retirement. You probably won't need as much to live. You'll have less income, so the chances are high that you'll be in a lower tax bracket and not have to pay as much tax. So they say, let's just defer it down to that point. Well, first off, I don't really want to live on less in the first place in retirement to begin with. So that's not too exciting if that's the rationale. But even if that was the case, even if we did have less income in the future, the problem is if taxes actually go up, even if your income goes down in the future when you retire, you still might be paying the same amount in taxes anyway. Because your income, even though it went down, if you're paying a higher percentage on that income anyway, it can probably just wash out. So if you really feel the taxes are going to go down and you'll be in a lower tax bracket in the future, maybe the tax deferred route. But for most of us, we're not even seeing that happening. And I would rather just take tax-free income in the future, to be honest. But that's not even taking into account the Social Security taxes in the future, that if you make more than $32,000 as a couple, then your Social Security benefits start getting taxed. And so essentially, if you're not looking to pull out more than 30 grand a year practically in from your retirement programs, then now all the Social Security income is starting to be taxed depending on how much income you have outside. And so either way, ask yourself if you think taxes are going to go up or down, and how much income will your income really decrease by very much in retirement. And that will kind of help you choose which one to do. The second question you should ask is a dollar worth more today or in the future? All tax-deferred accounts require your money to sit. 401ks, IRAs, they will penalize you if you take out the money before 59 and a half. So we have to let the money just sit in there, even if we wanted to retire early. I mean, there are some stipulations, but most of the time, if you retire early or want to get out or want to use the money now, then you have to pay taxes and a penalty on it. So they make you stick it in there and they don't want you to ever touch it. The problem is, as we know, dollars are worth more today than they will be 30 years from now. And we would rather try to figure out ways to use the good dollars today. And that's what I love about the tax-free account. Since we're putting in after-tax dollars, it's very easy to pull money out. We don't have to wait 30 years to pull money out, and we don't get penalized for it, and we don't pay taxes on it for the most part. I'm not giving tax advice. There's a lot of things, especially with the Roth IRA. I'm not going to get into that, but generally there is some money that you can pull out without taxation. And so we would like to try to be able to use money now instead of just pushing it back into the future if we need it. And so ask yourself, is a dollar worth more today or in the future? And will I want to use more of the good dollars today? We don't know when a dollar is going to be worth 30 years from now. We don't know what your tax bracket's going to be, and we don't know what the dollar is going to be worth. So maybe locking money up might not be the best. Maybe being able to use it is better. And the third question you ought to ask yourself is, would you rather pay taxes on the seed or the harvest? Would you rather pay taxes on the big amount that all your money has grown to in the future on the harvest, or would you rather pay taxes on the little amount that you put into the account that grew into this large harvest? Many people that I know would rather pay taxes on the little amounts that they deposited into it than on the big amount that it's compounded to and that it's built to, because hopefully your account is worth far more than your contributions. So would you rather pay taxes on the smaller amount of the contributions or the large amount that it's grown to? Many times it's much better just to simply pay tax on the little amount and know without a shadow of a doubt that you can pull money out without having to pay taxes on it in the future on the large amount and pull out as much as you want without having to worry about taxation. That is a good place to be. So if you can't tell, I'm a big fan of tax-free accounts. I don't like the guesswork on the tax-deferred accounts that we have so many questions, we don't know what it's going to be in the future. So I'd like to make decisions that I know and I can understand today and let the future be what it's going to be. But I know that I'm set up to do well. So remember, guys, if you don't build your financial freedom, nobody will. So figure out what you want to do and stick to it, and let's get to work. See you next week.